Welcome back. You're watching In Your Interest. The mutual funds data for the month of July has thrown up interesting trends and insights on people's investment habits. Data suggests that an increasingly higher number of investors have started to invest in mutual fund schemes. As a result of growing inclination of retail investors specifically to invest in financial markets via mutual funds, more assets are now held by individual investors in comparison to their institutional counterparts. Out of every 5 rupee worth industry assets in mutual fund universe, 3 are held by individual investors while the remaining by institutional investors. Now this as per data collected by Association of Mutual Fund Industry and these revelations has come by the way of AMFI. It is seen that a vast majority of individual assets are now held in equity assets. The love for equity is clear and visible as 86% of individual investors' assets are held in equity-oriented schemes, 9% in debt schemes and only 3% in money market schemes and 2% in ETFs as well as fund of funds. The total asset managed by mutual fund industry has also spiked nearly 40% from 46 trillion in July of 2023 to 64 trillion in July of 2024. What does it really tell you about how and where people are investing? Let's discuss that. My colleague Suyash Maheswari here with me. Suyash, hi. This growing love for equity, how does one really explain it?
Certainly, Shweta, because if you look at the past 12-15 months, it's the retail investors and your domestic institutional investors that are providing this much needed support to the markets. Remember, we have seen a lot of things happen in the past, a lot of black swan events. We have seen war play out, COVID situation happened, and domestic institutional investors and retail institutional investors took every opportunity, every dip to bolster their positions. Whereas FIIs, foreign institutional investors, who remember are considered the primary drivers of emerging markets, when they were sitting on the sideline or they were rather selling, retail investors and your domestic institutional investors were using every opportunity to buy into the Indian stock markets, and I think that has paid off dividends for them. We look at how the stock markets have performed. I mean, over the last 1 year, I think Nifty has given returns of about 24% or so. Small caps and mid caps have given returns in excess of 50%. So investors have clearly made money that has not been made in any other market.
Absolutely.
US markets have not done as well. Japanese markets have done well last year, but look at what is happening over there because of the Japanese yen trade or unwinding of it. So I think Indian markets have offered relatively less volatility compared to our global peers, and retail investors and retail confidence in the markets is clearly evident from this data.
And retail investment by individuals more than institutions, because come to think of it, and we're looking at division here of the assets, 86% of individual investors are investing in equity. Now you compare that to institutions investing in equity, it's 18%. So
yes,
while DIIs are really uplifting and bolstering the market, there is no same confidence, at least in mutual funds it seems, and retail investors are playing it more safe.
Right. I think if you look at it, the data, this is mutual funds data, right? So I think domestic institutional investors are in general, they are taking exposure to equity directly. So they are going and investing in the markets directly instead of taking the FOI, the mutual fund route, or your fund of fund route, or ETF for that matter. Where they invest in mutual fund is in debt schemes to pretty much average out the volatility or perhaps diversify their portfolio, whereas equity investors or retail investors in equity mutual funds, I think that is a responsible way of investing. One, because there is a fund manager involved, it takes the onus from you to make those investment calls, and some dedicated person is taking those calls on your behalf, and also diversifies your entire risk profile, right? Because instead of investing in a few stocks, you have exposure on multiple stocks. So for retail investors, but one thing I think is concerning is that they are heavily invested in just equity schemes, and their exposure to ETFs, which are exchange traded funds or debt schemes,
for individuals,
is relatively low compared to your developed markets. But I think as the Indian bonds will start getting included in the multiple indices like the JP Morgan index and the Bloomberg index, for that matter JP Morgan index bond inclusion has already begun. The Bloomberg index inclusion will begin next year. So I think once that happens, retail money will start trickling into the debt segment as well, because I think liquidity is not there and it gets very difficult for them to exit such markets.
All right. we keep saying mutual funds sahi, and we were looking at the numbers here, and those numbers are really reflecting. There's been a 40% uptick in mutual funds, the money that has been trickling into mutual funds. The people and their confidence is building in investing through mutual funds in capital markets. But for retail investors to be investing about 86% of their total investments into equity as opposed to debt, and any person will tell you debt is safer than equity. What are you making of the risk appetite of these people?
See, that's what I was saying, right? Look at the credit and deposit gap that we have witnessed in this country. That's at 20-year high. So basically what is happening, people want to take loans, but there is not enough money for banks to give loans because FD is not as attractive anymore, right?
Absolutely.
At 8.75%, FD is giving worse return than any of these indices. FMCG, which has been a relative underperformer, has also given returns of about 14%. So why would an investor prefer to go in a fixed deposit instrument where the returns are much less? And look at how inflation has played out in this country.
7.5 to about 12 to 14%, which is what is expected from capital markets.
And inflation eats away 5% of that.
Absolutely. So the 5% shaved off from what you're earning from mutual funds as well. But before I let you go and before I close the show, I think it's also interesting and important to find out what happens in case of a black swan like event, because we often discuss that in case, I don't want to be a party pooper, but mutual funds were not to give you the kind of returns that they are giving right now. This high exposure to equity is not going to play very well for people.
Yes, but I would be more concerned about retail participation directly into the cash segment, because that they can sell their stocks right away, right? Because for mutual funds, because they are the ones making the calls, they are the ones deciding whether to hold a stock or not. I think wisdom will prevail over there. They will look at a particular black swan event as a black swan event and see what happened during COVID, right? Initially, we saw about a 25-30% crash in the market, but the markets pretty much recovered. It was a V-shaped recovery during the Ukraine war. Similar thing happened.
Right.
So the markets, yeah, they too tend to fall when a black swan event happened, but we have to believe in the recovery. And I think mutual funds, because they have such extensive experience in this industry, multiple years, I think they are better off handling the money of retail investors than retail investors themselves.
All right. So stay invested would be, of course, I think their wisdom and their mantra to their investors. But as far as data coming out there from AMFI, it looks like mutual funds sahi hai for a whole lot of people, especially individual investors as well as HNIs who seem to be investing more and far more than institutional investors in mutual funds. Those interesting insights as to how people are investing, steering a little away from FDs of late. That is what the data is suggesting, moving more into more riskier assets, equity funds in this case, and into mutual funds like never before. But with that, we have come to the end of the show. Thank you very much for watching.